Hey everyone, Brad Palladini from Palladini Law. This is another episode of Tax Court Takeaways. So this is where I dive into recent tax court decisions and give you guys some actionable takeaways from the case. So a recent one involved a trucking company which had failed to file its W-2s and W-3s. Now the W-2s and W-3s are filed with the Social Security Administration, not the IRS. However, if the Social Security Administration doesn't see that the W-2s and W-3s have been filed, it'll send out some warning notices to the taxpayer letting them know, hey, we didn't get these forms and you gotta file them. Now in this case, unfortunately, the taxpayer either didn't receive those notices or just ignored them. And when that happens, the SSA will then transfer the case to the IRS. The IRS will then issue penalties for not filing the W-2s and W-3s on time, and those penalties can be pretty significant. This case actually doesn't say how much they were, but it can easily be hundreds of thousands of dollars, especially if you have, a pretty large company with a lot of employees. So this case really hinged on a little known provision in the Internal Revenue Code, which requires that penalties be approved by a supervisor prior to sending them to the taxpayer. So this is just to kind of ensure that there aren't any rogue IRS agents out there issuing penalties for no reason. So the tax law basically requires that a manager look at the proposed penalty, make sure it's appropriate, and then send the notice to the taxpayer. But there are exceptions. One of the big exceptions is if the penalty is computer generated. So for computer generated penalties, there's not actually a person reviewing it. It's just a computer program saying that, hey, these W-2s and W-3s weren't filed. This is what the penalty should be, and it automatically issues the notice. So what the tax court ruled here was that supervisory approval or an approval from a manager wasn't required in this case because it was a computer generated penalty. So unfortunately, the taxpayer wasn't able to get out of the penalty assessment. Now, interestingly enough, the IRS has recently invested a lot of money and resources into AI to try to make their processes more efficient. So I think the question becomes, what happens in the future if an AI bot is looking at a tax return or looking at some other documentation and it determines that a penalty should be assessed, a process that maybe was previously handled by an employee but now being handled by a bot? In that case, would you be able to get out of the penalties because the supervisor didn't approve what the bot had determined was appropriate? We don't know. IRS is still early on with this technology, so issues like that probably won't arise for many years, but I think it's an interesting question to consider. The other takeaway from this case is file your W-2s and file your W-3s. Most payroll companies will handle this filing. It's not something that you should be doing yourself, but if you use any large payroll company, they'll handle that for you. Make sure they're doing it, ask for confirmation, but make sure the W-2s and W-3s are being filed timely to avoid pretty substantial penalties. And that is the latest episode of Tax Court Takeaways. If you have any questions, leave them in the comments. Otherwise, subscribe, lets us know that you like the video, and we will do more of them. Thanks.